Hi guys, and welcome to Freckle Finance. Today I'm going to talk to you about mutual funds. A mutual fund is a professionally managed investment fund that pools money from many investors to buy securities. Mutual funds are usually classified by their principal investments. The four main types of mutual funds are money market, fixed income fund, stock, or equity funds. They can also be classified as an index fund, which is a passively managed fund, which means there's not anyone actively managing this fund at all, and they usually match indexes such as the S&P 500 index. Index funds have broad exposure, which means that they are invested in several different industries, which gives you a broader range of investment areas, which gives you diversification, which gives you lower risk. When a fund is not a passively managed account, it is usually an actively managed account, which means there is an individual who purchases whatever they want to purchase for that thing, and they keep the ratios and stuff like that. This is the kind I hear most people talking about that they have when they have a mutual fund. An index fund's fees are generally much lower than an actively managed mutual fund. However, that doesn't mean that because it has lower fees that it's going to make less money and that you should avoid it. Generally, overall, indexes are much better value. As well, keep in mind that just because a fund is actively managed does not mean it's going to do any better. And as well, if you take into account that the fees are higher for an actively managed account, it's probably actually going to do worse than an equivalent mutual fund. If they were the exact same mutual fund, one was active, one was passive, the passive one will probably do better because your fees will be cheaper. For example, let's say that you have an index fund and the MER, which stands for management expense ratio, and that's basically all of the fees or anything that would be included in this account. All of that would be told to you as a percentage. And let's say that that percentage is 1%. And the actively managed account has a fee of 2.42%. Some of you may think that's low. I think that's really high, but that is actually the average cost of a mutual fund in Canada. So this is not some random number I'm pulling out of the air. So once again, the index fund is 1% and the managed fund is 2.42%. So let's say that because these are identical accounts, one of them being just an index and the other one being actively managed, that it makes 10% this year. That means that the index account, the money that you have will actually go up by 9%, but the money in the actively managed account will only increase by 7.58%. So some of you may be thinking, well, that's not really that big of a difference, but let's say that you have $10,000 that was invested at the beginning of the year in both of the accounts. Your index account would make $900 that year, and your actively managed account would make $758. Now still, that seems like a small difference, but let's say that you invest for 15 years and every year it makes 10%. Now this is obviously not necessarily what would happen, but I'm just trying to make the numbers easy here to show you the significant difference. So your index fund will make about $24,000 more over the 15 years than your actively managed account, simply because of fees, nothing else. So just to make my point extra clear, when you are getting a mutual fund, it's imperative that you look at the MER fees. You need to know what you're paying so you can compare. Now, unlike a GIC, this money is not guaranteed. However, you will get a lot more money than you would with a GIC. And one of the big pros is that your money is automatically diversified. If you, let's say, are putting your first $100 in the account, that money will be diversified over many sectors, making it a much lower risk. And that's something that you wouldn't be able to do investing in stocks, for example, because you would have to buy a bunch of one type of stock before you can get there. So this is definitely a step before you would ever get into stocks, would be mutual funds or ETFs, as I'll show you in the next video. One of the cons of mutual funds, aside from the very high fees that they have, is that if you, for example, don't want to be investing in one company, but all of the good mutual funds have that company in it, you don't have the choice to take that company out of who you're investing with in the mutual fund. You have to purchase the whole thing as a package. In future videos, I will be covering other types of investments and types that I do like generally better than mutual funds. However, the basic thing would be that if you're wanting to start with mutual funds, like I said earlier, make sure that it has low MER fees, as well as it being an index fund, such as for American ones matching the S&P 500 index. and the TSX S&P index for Canadians, because those ones are broad spectrum investments and they cover many industries within, the US and Canada. Mutual funds are a good place to start your investing, because I think as soon as you have about $500 in most places, you can open an account, and then you don't even really have to contribute that much in a month, maybe $25. I'm not even sure that it's required that you invest every month, but you should be putting money in every month, really. But when you have more money, it is more beneficial to have other accounts, or when you're more used to the stock market, like, you don't necessarily need more money to open up ETFs, which I will be covering in my next video. But in order for it to be worthwhile to get the ETFs, you have to use a program that you might want to be a little more comfortable with investing a bit first. But yes, so this is a good place to start, but it's not the place to make the most money on the market. If you find these videos interesting and informative and you want to learn more, please click subscribe, as I will be uploading videos every Monday, Wednesday, and Friday. Have a good day. Bye.